Welcome to the Nedgroup Investments Excess Accelerated Fund of Funds Q1 of 2019 Fund Commentary. Let us start off by just reminding everybody of who the underlying fund managers are that we use within the portfolio. So on the domestic equity side, we make use of ABAX, Fort and Mazi, with ABAX also managing a small and mid-cap equity portion. Quanta are used to manage a passive portion of the portfolios. On the property side, we make use of Bridge and Prudential, whereas on the fixed income and cash side of the portfolios, we make use of ABAX and Quanta. In terms of our direct foreign holdings, we have a great bunch of managers. Veritas, who are London-based, managing the global equity portion. Coronation, the emerging markets portion. FPA, who are based in Los Angeles, a flexible multi-asset portion. And finally, Resolution Capital, based in Sydney, Australia, who manage a global REITs portion. In terms of the underlying asset allocation of the portfolios, as at the end of March 2019, the fund had 55% exposure to domestic equities, 8.5% to domestic property, 8% to fixed income, as well as 20% to direct foreign equities, 4.5% to direct foreign listed property stocks, and 3.2% to direct foreign fixed income. So in total, this gives the portfolio direct offshore exposure of about 28.5%, Rand hedge stocks of about 24.5%, and pure SA equity and fixed income and cash exposure of around about 47%. So well over half of the portfolio is directly exposed to offshore markets. In terms of the top 3 equity holdings within the portfolio, that would be Naspers at 4.4%, Sasol at 3%, and British American Tobacco at 2.9%. In terms of the performance of the portfolio, it had a strong start to Q1, with the fund up 6% for the first quarter, relative to the peer groups of 4.7%. Over the last 12 months, the fund is up 4.2% relative to the peer group, up 4%. In terms of what were the main contributors during Q1, the domestic equity carve-out did really well over the quarter, led by the Rand hedge stocks such as Naspers, British American Tobacco, and Richemont, that were all up somewhere between 20 to 30% for the quarter. The decision to also maintain duration in the domestic bond carve-out also paid off, with the South African bond markets gaining in terms of fixed income over the first quarter, largely due to 1, global bond yields decreasing, 2, the South African Reserve Bank keeping rates unchanged for the first half of the year, and lastly, Moody's maintaining the country's credit rating and not downgrading us to junk bond status. The offshore exposure, including emerging markets, also helped the portfolio, with all asset classes offshore performing really well, and in particular, global equities were up well over 13% for the quarter. In terms of trades within the fund, trades were kept to a minimal without any material asset class or fund manager changes over the last quarter, but rather we used just the daily inflows and outflows to maintain our asset allocations at the desired levels. So overall, it has been a strong start to the quarter, up 6%, and we certainly hope that these portfolio returns can continue for the rest of 2019.